Hey guys, I wanted to invite you to watch a special video that we did with one of our internal groups. We have a service called Infinity Investing 360 Pro where we do a lot of group coaching. And one of the folks that we brought in was a gentleman by the name of Kevin Simpson. And we've been following Kevin for quite some time, and he's come in and spoken with us before. But this particular recording I wanted to make available on my YouTube channel as well, because Kevin is talking about the market headwinds and why the market seems to be resilient in spite of everything we're hearing about recessions and the Fed raising interest rates and the market slowing down and all these things. Why is the stock market still going up? Why are certain people worried about it and other people like Kevin are not worried about it? And which companies are poised to do the best during this period of time when others may be jumping out of the market and others are worried about a recession and people are really worried about the market crashing? Why are folks like Kevin looking at this and saying this is a great opportunity? So I'm going to share this video with you right now. All right, guys, this is Toby Mathis, and I'm joined by Kevin Simpson. Kevin, Capital Wealth Planning, also one of my favorite ETFs, Divo, which I'll promote heavily because I love it and I can. But thanks for being with us again.
Thanks for having me, Toby. Always a fun time.
Hey, since we're doing this could be used in a couple different ways as a recording, but also for the folks that are live, they can ask questions. If you're going to ask a question, ask it in the Q&A, the question and answers. Just click on that. You can always chat as well, but the chat is not as nearly as good as the Q&A because chat flies by and sometimes we don't see it. Q&A will just stick there, and I'll ask Kevin really smart questions that you all ask. If you're watching the video, then you can always leave comments, and we'll even try to get Kevin to get those later. But for right now, we'll just do it this way. So first off, Kevin, since you and I last spoke, the market's been all over the place. And I think the big question everybody has is are we going to go into a recession or already in it? Are we already in a recession? Like what's going to happen with this economy?
In the old days, the definition of a recession was pretty easy. It was 2 quarters of decelerating economic growth. And over the past few years, and I don't know when it happened, but we kind of turned over the responsibility to the National Bureau of Economic Research, which then tells us after we've been in a recession whether or not a recession actually happened. So for the 2023 purposes, I don't think so, primarily because of the resiliency of the labor market. Seeing on average in excess of 200,000 job creations every month makes it very challenging to really justify us having been in a recession. Now, you may see a little economic contraction here and there along the way, but the resilience in the labor market, I think, is making it almost impossible to declare a formal recession. And then, like anything else, when you talk about economic compression, economic uncertainty, you get affected in different ways. So I think that there's lots of people who certainly are feeling as if there may be a recession in the moment. But as far as the formal definitions, I don't believe so. And there's a possibility we sidestep it. I mean, the narrative of the soft landing, Toby, is what's carried this market on its shoulders this year, even if the stock market isn't up. And we all know it isn't. I mean, there's 7 names that have carried equities, but for the most part, it's been a challenging 2 years, and rightly so. When you have a Fed that's increasing interest rates from 0 to 500 plus basis points, you're not going to see any movement in the stock market. We got lucky with an AI enthusiasm and it moved a handful of names, but for the most part, we're talking about a market that's experiencing the effects of a soft landing, even in the wake of this incredibly aggressive rate hike environment. Doesn't mean we're going to have a soft landing, because a hard landing happens without a whole lot of notice, just like a recession. But so far, inflation's come down. Growth has slowed, but not more than the inflationary numbers. And we have seen a Fed that hasn't been as aggressive raising rates in calendar year 2024, nearly to the extent that they were in 2022.
Hey, there's a couple of folks that are just, let's make sure that we understand who we're speaking with. So this is Kevin Simpson of Capital Wealth Partners. You manage how much money right now?
About $9 billion.
Yeah, so this isn't the guy down the street. So I want to make sure everybody understands. You're talking about somebody who has a very major responsibility to the folks that he's actually managing the monies for, fiduciary responsibility, and this is not somebody who's playing on Reddit or some of these other games where they're going to say, hey, this is going to crash or this is going to move. This is somebody who's very serious. And so I just appreciate that you're on and you're able to talk to our folks. Some folks are just asking. Speaking of Divo, since you manage that fund as well, what are the kind of the actions that you've had to take in the last few months because of this market? Has it been something where you've had to reposition? You've had some companies probably jump up in value where you had to reallocate those funds?
Well, the truth, Toby, is for the past 2 years, we haven't had that many stocks jumping up in value. I mean, for the most part, when you break out the economics, the equally weighted S&P 500 is down on the year. The Dow Jones is practically flat on the year, and Divo is practically flat on the year. Most deep value managers are, deep value is in the red on the year, because if you look at just utilities are down 20+% on the year. So it's been a year where stocks jumping up have been few and far between. And maybe there's 7 to 10 names that have really had good years, but they're coming off of a pretty horrific 2022, at least if we're thinking about NASDAQ names. So for us, fortunately, we do have an allocation to all sectors. So where I may be somewhat disappointed in the utilities or the traditional telecoms, our allocation to technology has been great. And we do have Microsoft and Apple, both in Divo. Microsoft, Toby, we've owned for over 10 years. So it's not like it's a new name to the portfolio, but boy, has it had a good year. Apple, kind of under the same spotlight, we've been in and out of fully 8 times over the past 11 years. We do have a full position in 2022. So those positions we've been trimming along the way. We like to keep about a 5% maximum holding per position. Now, it doesn't mean if it gets to 5.1, we're computer rebalancing immediately. But if something gets to a 6-7% weighting, you're going to see us trim it back to that 5%. So fortunately, we've had a few names, Visa, another one that's had a pretty half decent year, where we've been able to take profits and sell into that strength while still maintaining that position. And then what we've been doing, and this is what every investor should do, is you take the money that you're profiting from. You're just taking some chips off the table. The old adage of, trying to buy low and sell high. It's easier said than done sometimes, but we're taking money from these profits and we're redistributing them into the other sectors that were underperforming. And for a good portion of the year, energy was a space that was underperforming. It's caught a little bit of a bid recently. It carried the portfolio in 22, but we're adding money into sectors that were underperforming. And you can think of industrials, you can think of healthcare, you can think of pretty much everything that's not mega tech AI related, that you have great valuation opportunities here. It doesn't mean that we're going to have a short-term massive rally into year end, because I don't know that the higher for longer narrative has really been defined yet. But when we think 2-3 years out, they're going to start, the Federal Reserve will start cutting rates at some point, probably a year from now, the end of 2024, if I had to guess. And at that point, it's not going to be at the expense of growth stocks. People will always pay up for growth, but you'll see all these great names that have just kind of sat with good valuations that have increasing earnings, and we'll get into some of that, increasing dividends. So I'm positioning for maybe the second half of next year and into 2025 with every move that we're making here at the end of 2023.
Wow. So you actually sound hopeful.
I am hopeful, Kobe. I mean, I'm bringing some raw enthusiasm to today's conversation. And here's why. We've been pleasantly surprised. There's no hope for the stock market in terms of the broad markets until the Fed's done. So we get that. So here's 2 years where we're just trying to tread water, and we've done a good job just kind of towing that line. But you have an opportunity where companies that have underperformed, if we think of the aristocrats just as a category, companies that for 25 years have consistently increased their dividends each and every year. I mean, they're doing nothing this year. They were down last year. But in the second quarter, because here we are at the start of Q3 earnings, in the second quarter, the earnings average for the S&P 500 was down about 6% year over year. And we celebrated that with great enthusiasm because it was better than feared. Mm-hmm. The aristocrats on average were up 10% year over year. Profit growth. Nobody cares. Nobody gives it a bid. There's still it's still an auction market. You need buyers and sellers. But the valuations that exist in the companies that we own, that the aristocrats or dividend kings, kind of in that vein, their earnings are increasing, and their dividends are increasing. Johnson & Johnson, just today, for example, as we're recording this, They beat on top and bottom line. They increased their year-end number by just a little bit. Market was somewhat disappointed that they didn't raise it more. They've increased their dividend for 61 years in a row, and it trades below a market multiple. At some point, you're going to see that stock continue to trade higher. And those are the opportunities we look for. Earnings growth, dividends, dividend growth.
But you're not just making money on the dividends. You're not just sitting back hoping that they go up. You're also you're writing calls on these, right?
Yes, we write covered calls tactically, which is different than some of the other covered call strategies out there that are more systematic, that look to generate yield for a primary objective. For us, the covered calls become more of a risk management technique, because what I'm looking for is total return over time through a full market cycle. My assumption is that the stocks that we select, assuming they make money and make more money the following year, that their share prices will eventually appreciate. Like someone will eventually recognize the value of these companies. And as such, I want to be a participant in the stock over the long term. A lot of the return comes from stock selection, certainly not all of it, but I want to own good companies and I want to benefit from their price appreciation over time. The dividends matter, and the covered calls are a means of kind of harvesting volatility to hedge a little bit of the downside. And the byproduct of it certainly is cash flow. But unlike another covered call manager that might want to write covered calls on everything all the time, we're a little bit more frugal about our call writing. We'll still get another 2 to 4% a year in option premium, and that's going to be on top of a 2 to 3% dividend. So you're talking about 4, 5, 6, maybe as much as 7% cash flow, depending upon volatility. But I will say that as an option person, 2023 and 2022, maybe even more so last year, was the exception that proved the rule. We haven't had good markets, but we also haven't had tremendous volatility. Usually there's an inverse relationship. Usually when there's greater volatility, you're in a tough market. When the volatility is asleep, you're usually in an appreciating market. And certainly in 2022, that wasn't the case. And then depending upon how you quantify the performance of 2023, for most stocks, it's still the same, just stagnant, non-existent market.
What are some of the companies then that you're looking at that you think might be undervalued, that you're saying, hey, you know what, these are really great companies. They pay out great profits. They've been increasing their dividends, which just means that they're rewarding their shareholders for actually owning them, as opposed to a growth stock may not pay anything and their share price might go up as a result. But what are the companies that you got your eye on?
Yes, I think you always want to compliment us with growth, because I think investors always pay up for growth, but that's not the world in which we live in. And it has more risk and more volatility. So for us, we want companies that, again, it's a simple concept: make money, pay dividends. So I think of UPS as a really good example right now of something that's kind of jumped in my head as you were talking, because it's so beaten up and it's so low in terms of its multiple compared to where it historically trades. You're getting a dividend that's over 3%. Over the past 5 years, they've increased their dividend on average by over 13%. They admittedly are hit by higher gas prices, higher fuel prices. The obvious elephant that was in the room, the contract that they did with the Teamsters, they had 7 years to prepare for it. Wasn't a surprise. You knew you had to pay up, and they stood up like a good company and took care of their employees, who well deserve the raise that they're getting. But if you think about a logistical company that's no dummy, maybe Amazon's better, I don't know. But from a global logistics standpoint, there's far fewer companies than UPS that have the ability to put that math into their equation and come out with a continued profitable business. The contract's a little front-loaded. Stock should have gone down, but I think it's incredibly undervalued and an opportunity for us. Again, 2-3 years into the future, we'll look back and be like, yeah, maybe when they had that contract dispute, we should have bought it.
Yeah. Well, great comments. I got to just say this. Somebody just chatted this in. I'll just say this. Just throwing this out there. Kevin's market update emails are the absolute bomb. So how does somebody get those, Kevin?
Thank you. I guess if you go to capitalwealthplanning.com, we have a sign up for our monthly newsletter. But thank you for the compliment. It's not written at a level that is going to put you to sleep. I try to make it short, sweet, but have good relevant content for the week. But thank you for that.
Hey, they just put the link in there. And I would actively encourage someone to follow guys like Kevin, but also follow thoughtful leaders in this industry, because it's really easy for folks to go out there and get clickbait on YouTube and Instagram and Facebook, like everything's crashing. And it's like some of these guys.
Here's why everything's not crashing. So I'm not bringing the, I'm not, I joked about the raw enthusiasm, but markets are fairly valued. So we can't expect them to go a whole lot higher. We also don't expect them to crash. Now, if you have a hard landing, if you go through a recession, I think a normal expectation would be a 10% decline. That's not a crash. That's a normal pullback. And generally speaking, with the exception of this 12-year period of zero interest rates, I mean, you get 10% pullbacks like more than once a year, kind of on average. We were spoiled in 19, 20, and 21. But if you think about the mathematics, because that's all stock investing is, we all try to overcomplicate it, but it's not hard. We're based on, stock prices are based on how much money does a company earn and what multiple did we put on them. And when you have higher interest rates, generally speaking, the multiples will come down, and you would assume that earnings might come down a little bit. So that makes it a little bit more pressured on equities. But if we look at 2024 and we say, okay, well, the S&P 500 is going to earn somewhere between 240 to 250. That seems to be a consensus expectation. Then you've got an S&P that's going to trade between 4,200 and 4,500. And maybe if you put a 20 multiple on it, you can get to 4,750 if you like push hard enough. But somewhere between 4,500 and 4,200 is really where we should be trading, if you think an 18, 19 multiple makes sense. And I do. So on September 14th, we were at 4,500. Last week, we were at 4,200. If the market has a 3% rally into year end, which I think would be great, a quarter for 3%, multiply that by 4, straight line math gives you 12% appreciation on the year. I think that you're looking at a market that's pretty fairly valued. So for those people that talk about doom and gloom and a correction, it can always happen. But we're coming off of a pretty lousy year last year, and not much has done anything this year. So if you go back to the end of 2021, there's not a whole heck of a lot good that's happened. I mean, we had a pretty solid correction in 2022, and I'm not convinced that we've really seen a recovery in 2023. The S&P 500 is not an equally weighted index. 72.5% of the returns that we look at are from those 7 names. And if I sound bitter, I'm not. I just can't own them because they're not in my universe of stocks. And that's why I think diversified portfolio makes sense. Yeah.
Yeah, they're pure growth and speculation, and it's frustrating because as a shareholder, again, I wouldn't loan somebody money at 0%, and I don't expect to buy a company and not get paid. But apparently, there's a lot of folks that are. They're willing to do it. They're willing to play that gamble.
So if we're thinking about the 7 stocks, there are companies that are profitable. This isn't like 1999 into 2000. Like there was a real problem there. I mean, those companies did not make money. There was no PE because there was no E. You just had this little thing that looked like this. It's an infinity sign. That means it doesn't make any money. Here, I think the companies in some instances might be a little stretched on their valuations, and they can grow into them. But there's not a meme bubble or an NFT bubble or a .com bubble. You just have some enthusiasm, which may turn out and prove to be really correct. But you need to stick with those big profitable businesses. And I can't invest in them because they don't pay a dividend. But it doesn't mean that they're something that they're not Oedipus whoever was with the wings and the wax in the.
He flew too close to the sun, and he melted.
I should remember my analogies before I start spouting them out. But the point is, Toby, you and I love conservative blue chip companies that pay dividends, that have low multiples, great fundamentals, because you never get hurt. You don't get hurt, and that's the key to investing. You need to live to fight another day, and over the long term. Even though these companies aren't doing anything this year or last year, and again, you can look at the aristocrats, the Dow, the equally weighted S&P, there's great opportunities here and real ones, not chasing things that are going to be the next chatbot AI, GPT, whatever. That's a real company, but you're going to see every huckster in the world come out with the next version of it. Well, there's probably going to be 2 or 3 that are great, just like when the internet kind of came out and you had solid companies that really stood the test of time. But I think that the idea of chasing some of the next hot things that are going to be riding those coattails will be very difficult.
I think we were both wrong. It's
It's
Icarus.
Icarus. No, I thought of it after that. I knew as soon as I said it wrong. Oedipus was a whole different story, but Icarus flew too close to the sun. It popped
Oedipus,
in my head.
Oedipus was a slightly different story.
Yeah, yeah.
Hey, the same ending, crash and burn. Um, something you said, this is the thing. I look at this, and these companies are still profitable, are still paying. Like, to anybody who hasn't sold them, the universe hasn't changed at all. And I'm still shocked because I mean I just follow what other really smart people do. I don't have an original idea in my head, so I know the tax stuff. That's my world, and then I know the finance, the people that make money. I tend to do what they do, and I'm like, whatever they're doing, follow that. And it seems to me that we have this popular culture of chasing after and wanting the big bump, as opposed to the boring dividend paying companies that just keep paying you quarter after quarter, sometimes month after month, and just taking that money and either reinvesting it. Probably the best thing to do is just do a drip and just have it go back in if you're an individual investor. But I'm just shocked that people don't do that, and they always chase after these things.
Well, let's get into facts. Let's use actual math. Since 1926, and we may have actually touched on this in our previous conversation, but the S&P 500 has delivered a return of 10.2% per year, which is awesome. Sometimes it's up 30. We think we're brilliant. Sometimes it's down 30 and we want to, jump off a bridge. But it's 10.2% since 1926. Dow Jones and S&P keep these numbers. 39% of the return, so almost 40%, going back almost 100 years, comes from exactly what you just said, Toby: dividends and distributions reinvested. That's the secret to wealth creation. That's how you become really wealthy. Time matters too, longer time periods. But I think of these stocks now that we're talking about, these blue chip, these tortoises versus the hares, and they go through periods. I've done this for a little over 30 years, and it seems like once every decade or so, there's a period where nobody's interested in value. I remember in 1999, they literally were putting Warren Buffett out to pasture. He was too old. Value stocks were never going to come back. Everything was about growth stocks. And then it changed, and it's not a competition, although it has been more recently. I think it's a combination. I still think you always need to have some growth, but when you have underperforming periods, they tend to have multiple year expansions where value does really well. It was also in 2009 we saw the same thing. Value stocks couldn't catch a bid. Now, it was coming off of an '08 financial crisis, and Q1 of 2009 wasn't that great either. But the value stocks were so underperforming relative to their growth peers. Here this year, and I don't have the third quarter numbers yet, I'll get them soon, but through the first half of the year, Ned Davis does a great study. He looks at the S&P 500 and he takes dividend-paying stocks and non-dividend paying stocks. Through the first half of the year, there's about 100 companies that don't pay a dividend in the S&P 500. They were up 18% through the first half. The other 400, everything else that pays dividends, weren't even up 4. Like 3 and change. So when you see periods like that, in 2009, it was even a greater variance. Like value was even more underperforming in 2009. But what I did is I went back and I said, what would happen if I would have bought some stocks on July 1st of 2009, the last time we saw this happen? UPS is up over 13% annualized per year, stock we talked about earlier. That's 13% total return. I think Walmart's like 11.5% per year. So double-digit returns are like a very boring stock that you don't really think about. And Home Depot is up over 24% annualized per year since July 1st of 2009. So those were some kind of things that really validated in my head. Like, I know what to do. I don't get really worked up over too much, but it's frustrating when you're looking at a stock that is a good company and it's just not appreciating on its price. But to your point, you're just continuing to collect these dividends. And if you are using old school dollar cost averaging as a combination with the compounding, when they do go up, then you have exponential returns. Again, true wealth creation. That's why I'm wealthy.
And that's Warren Buffett too, to a T.
And it comes from Benjamin Graham before him.
Yep. And you look at what these guys have done, and it's consistent. Again, they're not gambling; they're picking the sure horse, which is paying out. And bird in the hand is worth two in the bush. Warren Buffett, I think, famously once said, "It depends on over what time, right?" So, like, you want to have this nice return, and if you're willing to wait for it, you're going to get a nice return. Sounds like there's a lot of opportunity then. And again, I'm just contrasting this. I'll give you an example. I put a a question out of my social media of whether they thought a recession was going to happen within the end of the year in 2024. Like, what's the chances? 85% on one of them was we were going to go into recession, 75% on the others. And everybody's saying we're going to go into recession. We're going to go into recession. I look at it as you might be right. Maybe that's the case, but it's overwhelming negative sentiment.
Well, it doesn't, the stock market doesn't care if we go into a recession or not. So if we go into a recession, like as we introduced the topic in the beginning, that affects the people the most that can least afford to be affected by it. So the recessions are really bad, but maybe not to the stock market. No stock is recession proof. Recessions are not good. But the idea is that there's the majority opinion could very well be right because they put so much pressure on it. When you take a Fed that does this, there's a lag effect on inflation. Coming from 11% or 9% down to 4% is a heck of a job. But coming from 4 to 2 requires maybe a recession or at least some economic contraction. The stock market might not care because if we're in a recession, then it gives the Fed fuel to cut rates to re-stimulate an economy that they just put in the recession. So the stock market will look past that. The challenge for investors with an emotional ties to managing money is you think, well, I got to wait till after the recession because then it'll be better. But by then, the possibility of a capitulation to the upside is that you could miss some pretty strong movement. So the idea of always wanting to wait for it to be better is hard because it's a 2-decision process. I got to go to cash and I got to get back into it. And now it's even harder because it feels so good. It's warm and comfortable in a money market. You get 4 or 5%, who knows, maybe even 6%. Feels great. If you have a 3% inflation, then your real return is only 2%, but that's still way better than we've seen for the past 12 years. So there is an alternative now that didn't exist before, but you don't have any inflationary hedge against it. So I still think you always want to have your safe money safe. And the fact that it's earning more now is awesome. You want to have a little bit of growth, profitable growth, because that makes sense. And then the core of what we do, this hub and spoke model, that dividend growth is where we have the ability to truly fight inflation. Because if we have companies that on average are increasing their dividends, let's just say at 10% per year, it might not, could be 9, could be 11, but let's just say 10% on average, you're getting a 10% raise each and every year, no matter what's happening. So if there is inflation, even if the Fed gets it to 2%, inflation still exists. It's that dividend growth that is the real fuel behind it. Now, the companies have to have earnings growth to support it, or you need to swap the companies out. But the methodology for that type of investing, it has worked long before me, and I know confidently that it'll work long after me.
Let's I have a couple questions here, but I do want to just give you a second to talk a little bit about Divo, because you have the ETF that someone can just go buy right now, Divo. Does that pay out on a quarterly basis, or somebody, is that something where they actually might receive something, or is their money locked in?
Well, the ETF distributes monthly, just about a 5% cash flow. Sometimes it's 4.8, sometimes it's 5.2. I'm not, put a little asterisk there. But over the past 6, I think we've had it for 6 years, maybe 7. It's paid about 5% a year, and it distributes that monthly. So if you are dividend reinvesting like that is very powerful. I don't know if I mentioned this to you previously, Toby, but about a year ago, we launched an international sister fund to it. The symbol is IDVO, IDVO. And it's the same concept. It's just using big ADRs that pay very robust dividends and writing US-based covered calls on the ADRs. But they're non-US, so there's certainly more risk, I think, with international companies than with domestic companies. But it's having a really good year, and it does distribute monthly like Divo. And I think that distribution is in excess of 6%. So if you have to invest internationally, and I was taught the business that you don't have to, that I can lose enough money in the US, I don't need to invest internationally. So this is my first international investment because I'm running it. So I better eat my own cooking. But it's a small percentage of my assets because it should be a small allocation if you're investing in an international fund. But there were a lot of financial advisors that want international allocations in their portfolios. And they said, if we're going to have them, we'd rather have the Divo approach. Give me big dividends, covered calls, than just going a little willy-nilly with long-only strategy. So it's there for those of you. It's like the guy in the commercial. I don't always drink beer, but when I do, I don't always invest internationally. But if you do, IDVO is certainly one that I would take a look at.
And these are companies that you manage. And again, just for folks that aren't familiar with Kevin, who is a fantastic money manager, financial wizard, and great, willing to come on and talk to us, which is something I don't look at lightly as well, is that you're actually willing to go out there and talk. A lot of financial advisors refuse to be on camera for anything for obvious reasons, because a lot of times they're wrong.
Yeah, we're not always right, but the good thing about it is we always have a reason for what we do. We are not always right, but there's always a rules-based process for how we buy a stock, how we sell a stock, how we write a call. Nobody's always right, but if we're right more than we're wrong, then things tend to work out really well.
Well, you've obviously been right more than you're wrong. Divo is up. Like, I don't know if you have your numbers for the last 5 years, 10 years, or since you started it, but I know I think the last time I looked, it was strong double digits.
I think the average returns like 11.5%. These are round numbers. This year we're flat. If we're up 1%, we're up 1%. But this is a very unusual year. Last year, I think it was down 1.5%, which was really great. But my perspective, from my lens, once they're raising rates, I just have to put a belt on, put suspenders on, and wait it out. And when they're done, then I'm back in business. I don't want to lose a whole lot in the interim, and we haven't. That to me is something I'm very, very proud of. But we're accumulating all these stocks that I think are cheap, undervalued. Schlumberger, ConocoPhillips, Chevron, these energy names, they're just printing money, and they don't care about CapEx. They care about giving money to shareholders. ConocoPhillips and Schlumberger have special dividends. They're growing their dividends. Chevron we've had for over 10, 11 years. I mean, it's a pretty stalwart. Everyone's saying, well, what's the price of oil? What's the price of oil? It's not we're not commodity traders. These are businesses. They certainly can make more money when oil prices are higher. That's for darn sure. But these are businesses that are just catering and dedicating themselves to shareholder value and shareholder cash flow. So we're accumulating, just accumulating.
And I would just say, to reiterate, that have been paying out increasing dividends through multiple recessions. Like,
yes,
they honestly don't care about the recession. They deal with it, but they continue to grow. They continue to reward their shareholders for their investment in those shares, and they just keep rolling forward. Is that a fair characterization?
100%, because there were periods of time when the energy names were the worst performing sector in our portfolio. We didn't sell them. We wrote covered calls on them. We collected great dividends. You can think of like when the price of oil went from $1.30 to 30. Like that happened. You can think of
zero.
Yeah, it was negative, all right. That was later.
I'll give you $20. Take it.
You can think of the COVID shutdown when we were never going to drive or fly again. I mean, there's always opportunities, and I still think the energy space makes a lot of sense. The electric car is an amazing concept, and it's growing every day, but it's not something that's going to dominate the roadways tomorrow for all of us. So there is a runway where we can still own the petroleum companies, the fossil fuel companies, and we'll make every penny we can until the lay of the land changes, because someday it will. I mean, Elon Musk is no dummy, but the time frame is the thing that we're thinking has a little bit longer to go.
I think Elon Musk was very clear that we need fossil fuels in the meantime. If they are actually fossil fuels, who knows? But we still need oil and gas for sure. Hey, there was a couple of questions about the national debt. So I heard it enough to where I'm going to ask you, what impact do you think that this runaway national debt is going to have on our economy, and will it affect the stock market?
Oh yeah, massively horrible. Not today, but eventually you pay the piper. You can't have trillions of dollars owed when you're not fiscally responsible. So the stimulus that happened during COVID, I think, made sense. I think that was the right thing to do. But so much wasted stimulus happened since then, and it's a very it's a big problem, because it's not just the Fed that can go in there and talk about tightening, quantitative tightening. You talk about budget and federal deficits, and you need a responsible Washington. And try to steer clear of politics and religion, but we don't have a stable Washington. We haven't for a long time, and the future doesn't look all that bright.
Well, they definitely. I always say there's two taxes: the tax you pay, and then when they print money. And it seems like the government's never going to run out of money, guys. Like they're just going to tax you, and the tax might not be an overt, hey, pay me money. They might just print some more out and devalue the US dollar, which
Let's
you
get rid of student debt, Toby. We'll just make it go away. Because I didn't learn that in economics. Like, where does it go? Oh, it's gone. It's gone. It went away.
Nobody has to pay it. Yeah.
Yeah. So
What effect does that have on us?
that's a silly, it's a silly concept. If people are struggling and they need more time to pay it, there's certainly, like when we went to school, many institutions that will help leverage that. And I remember paying it off and how awesome that felt. But it can't just go away.
So Kevin, I was in a Catholic high school, and I remember some folks were running for student class president, and the guy that won was the one who said, "We're going to put a soda machine in the cafeteria." That was the premise of running. It was like everybody was like, "Yes, this would be great to have a soda." It's like, no, you're not going to have a soda machine in the cafeteria. Like the nuns or the brothers would look, but he won.
Yeah, well, you should have said that we're going to have no school on Friday. I mean, you won.
we're gonna
follow through. Look at what, yeah,
would have been a good one.
It's just making the promise and getting elected.
Yeah, we could actually you could actually have hamburgers on Friday. Would have been a big one at the Catholic school. It's not just tuna for a change. But I always kind of look at it. It's like there's all this stuff that you could promise, and the government seems to be in that, and they have to pay for it. And so it is going to have an impact. Do you think it's going to elevate the market? Because I always look at kind of whenever you look at inflation, it seems to rise. Growth and inflation are the two big factors, I think, push things up. But do you think it's going to help or hurt?
No, I think ultimately it hurts the market because it reduces liquidity. So if you think about the debt service, it's almost like there is a Fed put on interest rates. They say there isn't, but maybe not to the extent that they're going to be buyers, because they're certainly letting things roll off their balance sheet right now, which is good. But at some point, you can't have rates back at the level that we saw in the 70s because we can't support the debt. How much money goes towards debt service right now that we pay? There wouldn't be enough money. I have no statistic to prove this, so I'm not sure that I'm certainly not saying this as a professional, but I'd be curious to know how much income per capita we have as a country. And if you taxed everything we made, would we be able to service a debt if interest rates were at 15%? I don't know the answer, but
it's crazy. It's going to be our highest, our largest line item above Social Security for the first time, I think, in history. This year, I think it's actually coming up where that the service of the national debt, which means inflation, like interest rates have to go down. The government's going to not allow itself to implode. And
right.
Although the Fed and the government are not, they're separate, right?
That is an independent body, but
yes,
government puts the independent body in.
Yeah, they're not going to let the host die, so to speak. Some folks are asking, it was Divo, that's your ETF, and then your international is IDIVO. Is that correct?
It's IDVO, because I think we could only have four letters. IDVO.
Okay, so there's no
international Divo.
All right, international Divo, IDVO. Yeah, perfect. Somebody was asking, are you able to invest in things like NVIDIA or NVDA?
No, because I remember being on CNBC once, and they said, well, NVIDIA pays a dividend. Why don't you own it? And by the way, my dad asked why I didn't own NVIDIA last week. So maybe that's a top. But I said, well, show the dividend yield, and then let's take a vote and see if that actually counts as a dividend. Because if it does,
minuscule is the word that my guy said. He goes, even though the dividend is minuscule.
Yeah, it's just a little too minuscule, because I would love to own it. I don't follow it enough to recommend it. But I mean, I think of companies like Google and Amazon as really incredible game-changing opportunities. We do own Microsoft, and like I said, we do own Apple, so I'm familiar with the space. But I think if those companies were dividend growers, and I think someday they very well may be, that they would be candidates for us, which is why I think having profitable growth companies as a piece of an asset allocation puzzle is important, because you want to complement them with us. They got destroyed last year, but they're doing better this year. And,
somebody asked a question. I don't want to throw a curveball at you, but they said, we're talking extensively about the importance of value in dividend stocks and ETFs, but do you use growth stocks in ETFs at all? And if so, what's the reasonable ratio? So do you use any?
No, but we're going to come. We're talking about coming out with the Divo, which would be like a growth version that would write covered calls on it a lot.
Mm-hmm.
So I mean, I think you should have 10% in growth, but profitable growth at least, because that's where you can make money. You can't have everything there. Like that's the problem, is that we sometimes, our eyes are, get real big when we see these returns, but like anything, things that can go up can go down. So and if you do rebalancing, it can work really effectively, because that's what I do. Like I own Microsoft and Apple, they went up and I just kept trimming them. So if you have an allocation to things that are in the growth space, and I think you should, depending upon your risk tolerance, it can be, I'm not a financial advisor, but if it was me, I don't, but if I did, I would have 10 to 20. If I didn't run a fund, because I have all my money in the fund, but if that wasn't the case, I think I would have 10 or 20% of my money in growth.
Mm-hmm. Small percentage overall, it's not enough to hurt you. If there's a pullback, it might be 2% of your portfolio. I mean, we kind of look at the same thing with cash and crypto and things like that. I'm like, don't not own it, I guess, if you really want to, but I don't equate it as an asset, and then it's no more than 2 to 3% of your portfolio. But I'm just a tax attorney, so I'm not a financial planner. But I just
Profitable businesses make sense, whether they're growth or value. And
why
you have to look at a multiple and
why is
say,
this so weird that there's not enough people out there saying it? Because I'm always like, you want a company that's going to be around in 50 years. I would say, like, I look at a 200-year plan. You better buy things that are going to be around for a while. And what the heck are you doing gambling?
yeah, I own Cisco. I mean, there's another tech name. And if you think back to the late 90s, they were a high flyer. It took many, many, many years for Microsoft as well to grow into that multiple that they
Yeah,
reached in 2000. But they're companies that just print money. Like Cisco is going to buy Splunk if the government lets them, and they're going to pay over $20 billion for it. And if they wanted to, they could probably write a check. Like that's pretty powerful. You get over a 3% dividend. They just make money. They're the pipeline to everything. They're old tech, they're boring, they're conservative, but they make money. That's what I
boring
like.
is good. Boring is good, and profit's good. And it went out of style, and hopefully it's coming back in. Somebody asked a technical question: is your strategy capital weighting or equal weighting?
It's not capital weighting. I have a 5% max. So, generally speaking, I own 25 to 30 stocks. So it's going to be more equal weighting. But when I enter a position, I don't enter it in a full 5% allocation. So if you look at our holdings, you'll see positions that are sub 5%. But generally speaking, we're more equally weighted for sure. You don't want to. The problem is you put a whole lot of money in Apple. It sounds great when it's $700, but then 3 months later, when it was $400, if you have a heavy weighting to Apple, your numbers look really bad. So keeping position size for us is the same conceptually, I think, for any of you investors who may do it yourself in terms of asset allocation. And rebalancing is good, because when the Nasdaq went down last year, you had a 10% weighting. When it went to 6, you could put some more money into it at the end of last year. Now you're seeing it rebound this year and high returns. And now maybe it's a 14% return. So you take that 4% that you have and you can put it over the other things that are underperforming.
That's perfect advice and perfect commentary, and I really appreciate you coming on. I don't have any other questions that I see right now. So I'll say, Kevin, I just really appreciate you coming in and sharing with us. You do a great job. Capital Wealth Partners, I assume that you're a fiduciary in that. That's for folks that come over and wait, you have to go through an advisor for that.
We don't work with any clients directly. So, I mean, we live to serve the financial advisor community. If people do it themselves, they have access to us through the 2 exchange traded funds.
Yep.
But we're not financial planners. We're not. You need people like Toby and your advisors to kind of steer the whole ship. I'm just a piece of a puzzle. I think I should be a big important piece, but I'm just a piece of a puzzle, and it needs to be complemented with other asset classes. And as long as I do my job, I think you said it earlier, kind of like this steady as she goes. So I'm just in the business of trying to keep things steady.
Well, you've certainly done a great job, and I appreciate you. So if somebody wants to work with Kevin, you could reach out. If you're in Infinity, it's really easy. You reach out, and we'll put you in touch with with an advisor that can work directly with Kevin, or you go to the ETF. That's what I do. And you in Divo or IDVO. Sounds like both are great options. If you want to go international, you do the iDevo, and if you want to stay domestically, just do Divo. It's simple, and you do a great job. And I just really appreciate you coming on and sharing with us again, Kevin. And hopefully, it won't be the last time.
Anytime you need me, I'm thrilled to offer up any opinions if you find it valuable.
Yeah, we certainly do. And everybody, give a reaction, give a thumbs up if you want to have Kevin back. Yeah, there they go.
Thank you.
Thumbs up. There you go. So definitely the invitation will be extended, and I just really appreciate you coming on and sharing with us. It's somebody who manages such a large portfolio and is responsible for other people's retirement monies. It's not just yours, and you're willing to come in and talk exactly about what you're doing. That type of transparency doesn't exist out there. So you are an outlier, sir. And I just want to say thank you. We really appreciate having you on.
Thanks, Toby. I'll see you again soon.
All right, guys. Until next time.